Hello my fellow investors and welcome back to another stock analysis video. Today guys, we're going to be taking a look at the company Devon Energy Corporation. This company was actually recommended by Wayne Lynch, where he pretty much just said, new subscriber here, I would like to see an analysis on Devon Energy DVN. I think it is a great natural gas company with an 8% dividend yield. But nonetheless guys, I think that we should take a look into this company, mainly because energy companies have been skyrocketing recently because of the oil and gas shortage that the world pretty much has been having. So I think this will actually be a fairly interesting company to analyze. So with that said, let's get started with this video. Coming into now the dividend summary, current dividend yield guys is actually 1.25%, which is significantly different than what you told me, Wayne, on your comment. And it's actually fairly interesting because if we take a look at their website, we can see that Devon Energy announced a second quarter dividend for common stock holders. And well, they actually declared a fixed plus variable dividend of $1.55 per share. So for some reason, I don't know why Seeking Alpha is actually saying that this is 18 cents or even 72 cents on the annual. So yeah, for that reason, I don't think any of these numbers make any sense at all. But nonetheless, they do have an annual dividend growth of 4 consecutive years, and their ex-dividend date did pass as of September 9th. Payout date is going to be the 30th of September, so in 5 days, and they pay their dividends quarterly. Coming now into the calculator, we got the market cap of $37.8 billion with a PE of 7.31 points. So with the current share price of $57.69, it's telling me that, well, this actually might be a fairly good price. Now, does this mean that the fundamentals can cover that? Not necessarily. We'll take a look at that in just 1 second. Annual dividends per share, guys, is $1.55 in accordance to their own website, not Seeking Alpha. And the amount of dividends paid out every single year in accordance to their shares outstanding, it is $1 billion. Now, looking at this on the 5-year average free cash flow, unfortunately, they do not have enough average 5-year free cash flow to cover this. As you guys can clearly see, they're into negative $16.7 million, which is not good at all. However, as of last year's free cash flow, if we subtract this $1 billion, they're still left with almost $1.9 billion. So that's a massive jump that they had on their last year's free cash flow. And these payout ratios actually show that. So you can see last year's free cash flow payout ratio is only 35.15%. However, as of the 5-year average, it is over 100% at 101.67%. So it's kind of all over the place, guys, unfortunately. Now looking at these fundamentals, guys, starting of course with the net income, we got 5 years ago of $898 million to 1 year ago of $2.8 billion. That is a massive increase of 213%. Now this graph, guys, actually is not the best thing on the planet. Now one of these numbers here that is actually in the negatives is understandable, right? The 2 year ago value at $2.68 billion in the negative, that one's it's explained mainly by the fact that the price for barrel of oil in 2020 actually came down into the negatives. If you all remember that, it went down to negative $30 a barrel. Now obviously this company is for natural gas, however they do kind of follow each other, so that pretty much explains that number. However, what I don't understand is this negative value 3 years ago of negative $355 million. Definitely something to do a little bit more research on. On top of that, guys, we could see that they had a massive jump from 5 years ago to 4 years ago from $898 million to $3 billion. And then looking at this, guys, they actually went down looking at the 4 year ago value to the 1 year ago value. So even though in the 5 year this is increasing, I cannot give this more than like a 25% because this just has a lot of negative values, and on top of that, a lot of just drastic movements all over the place. Looking now at the free cash flow, the most important of all the profit metrics, this is the one that companies use to pay out that dividend, make acquisitions, which they just made an acquisition, to buy back shares, to pay down their debts, and to just overall grow the company. Very important, guys, for this thing to be positive as well as consistently increasing. Now, this isn't the positive, but man, do these numbers just are all over the place, right? We got 5 years ago of $1.3 billion to 1 year ago of almost $3 billion, guys. That is a massive increase of 131% with an average of $999.8 million, so almost $1 billion in average free cash flow. The reason why I say that this is something that I'm not liking is because you can see by these numbers, guys, from 5 to 2 years ago, consistently decreasing, right? I mean, this is just looking really, really bad. 4 years ago, it was 533 million. 3 years ago, it was 130 million. And then 2 years ago, it was 193 million. And then from then on, guys, from 2 to 1 year ago, they just did a massive, massive jump to almost $3 billion, which is just insane. So you can see this graph is just looking all over the place, and for that reason I'm actually going to give it a little bit higher than that of the net income. There are no negatives, but it's still not something that I like, so I'm going to give it, guys, a 30%. Looking now into the revenue, we got 5 years ago of $6.34 billion to 1 year ago of $13.1 billion, increase of 106.89%. And you know, this graph is okay, I guess you could say, but we still see something similar from 4 years ago to 2 years ago where it was consistently decreasing. And on top of that, we do see also a massive jump just in general from the past 5, 4, 3, and 2 years ago into the 1 year ago, where essentially they went from $4.5 billion 2 years ago to $13.1 billion. That's a massive jump, guys. I don't necessarily like that. I do not like seeing all these spikes all over the place. It's not something I like to see because it tells me that it's not necessarily sustainable or consistent enough for me to be like, okay, they might continue to do this into the future. Could I be wrong with all of these statements? Absolutely. For all we know, this year they could be significantly higher. They could be a 14 or 15 billion dollars. But just looking at these values, guys, it is a better assessment to be safe than sorry and to say not sustainable. Let's bring it down a notch and be way more risk avert. So for that reason, I'm actually going to give this, once again, a little bit better grade than that of the net income and the free cash flow. So I'm going to give it, guys, like a 35%. In the assets minus the total liabilities, if we subtract these two values, guys, this tells us whether or not the company is able to sustain themselves in an economic downturn. And currently they're at $10.2 billion. However, taking a look at this graph, guys, from 4 to 2 years ago, consistently decreasing, and only as of 1 year ago and up until today, this is when they actually started to increase it a lot. Not only that, we do see a massive jump once again from 2 years ago of $3 billion to almost $9.4 billion the following year. Obviously, this could be attributed to COVID, but the 4 and 3 year ago numbers not necessarily is attributed to COVID, right? I mean, the COVID wasn't happening during this time, so why did they go down from 5 to 4 to 3 years ago? That is a question I'm asking here. Average total assets is $19.6 billion. Average liabilities is $11 billion. And doing this difference, we get $8.6 billion. I'm going to give this, guys, essentially like a 40%, maybe like a 45%. I'm going to go with 45%. It's because there are no negatives, which is good. And as of today, they have been able to consistently grow this 1 year ago from 9.4 billion to 10.2 billion. But nonetheless, I still don't like the fact that it went consistently down from 5 to 2 years ago. Looking now at the cash flow minus the liabilities, this one's actually looking very surprising because, well, normally what I find is that companies here, guys, do not necessarily have any positive cash flow minus liabilities, meaning that their cash flow cannot supersede their liabilities. Normally what I like to look for is, okay, are they at least bringing this closer and closer to zero? And well, this is actually looking fairly interesting because from 5 years ago to 2 years ago, guys, this was actually going closer and closer to zero, essentially becoming more and more positive. From 2 years ago to 1 year ago is when they actually went down a little bit from negative 6.7 billion to negative 8.7 billion. But nonetheless, guys, you can see the general trend for them is to actually get closer and closer to zero. Now, this is actually fairly interesting because if we actually take a look at this graph one more time, the assets minus the liabilities, we could see that essentially the reason why their assets and liabilities were going down wasn't because their liability was increasing. It was because, guys, their assets was actually decreasing. As you can see right here, 30 billion to 19.5 to 13 to 9 to then 21 and then 23. Now looking at the total liabilities, we could see that it has been roughly at around like that same marker at around like the $10 billion mark. So that's actually fairly interesting because this isn't a case that the liabilities are increasing and the assets are increasing but just at a lower rate. No, this was a case that the liabilities was roughly remaining the same, but the assets were decreasing, which explains this cash flow minus the liabilities. Average cash flow minus the average liabilities, we get around negative $9.6 billion. I'm actually going to give this guys a fairly good grade at around like a 75%. Looking now at the shares outstanding, and this is actually came in as a really big surprise because, well, you guys are looking at these values and there's just some very weird anomalies here. Guys, this metric is by far the most underrated out of all of them because people just tend to buy companies because the share price is going up, when in reality the company may be diluting you and giving you a smaller piece of the pie, and you think that just because the share price is going up, you're actually making money. Remember, when you buy a company, guys, when you buy a stock, you are buying a piece of a company. You are now an owner of that company, or at least a co-owner of that company. So your ultimate goal is to essentially accumulate as much share power in order for them to share more of your profits with you. So very important for this thing to be decreasing, because that automatically gives your shares more value. Looking at this graph, guys, we got 5 years ago of 525 million shares to 1 year ago of 655.8 million shares. That is an increase of almost 25% on the 5-year, but a decrease of 1.09% from the previous year to the current year. Now, looking into this graph, guys, we can see that from 5 to 3 years ago, they were actually decreasing it. Then from 3 years ago to 2 years ago, they kept it the same. And then after 2 years, essentially after COVID, they brought it back up, shooting it massively from 382 million shares to 663 million shares. And then from last year to today, they bought back, as I said, 1.09% of their shares. So this is all over the place, guys. They have had instances where they're buying back, they have instances where they've kept it the same, and they have instances where they have jumped it increasingly. So that's something fairly interesting, I'll give it that. Now, for a grade, I'm going to have to give this like a really low grade, I guess you could say, because I mean, they did jump it significantly high, but then again, they do have instances of buying back, and even recently they bought back. So I'm actually going to give this guys like a 60% or so, just because it's just all over the place, honestly. And now when it comes to the cash equivalents, they currently hold $3.3 billion with an average of $2.3 billion. Looking now at the overall grades, guys, let's see the net income. We gave it a 25%, the free cash flow 30%, revenue 35%, assets minus liabilities 45%, though this actually should be a little bit lower because of the fact that their assets are going down. Cash flow minus liabilities 75%, and shares outstanding at 60%, for an overall grade at around 41%. So it is failing. Their fundamentals could be a whole lot better, guys, especially that net income, especially the cash flow and the revenue. Essentially, the top 3 most important metrics, the profit metrics, should be a whole lot better. But that doesn't necessarily mean that at the current share price, we don't buy it. So let's actually use discounted free cash flow to see what we can actually get here. So now, guys, looking at discounted free cash flow, let's make 3 different assumptions, low, medium, high, using revenue growth, projected share buyback, and the required rate of return of 10%. For the revenue growth, guys, let's actually come over here to Seeking Alpha's Growth tab. We can see that the forward is 44.69% and the year over year is 120.07%. I do not believe these numbers, guys. For starters, they're way too far apart, and then on top of that, they are just very big. So my job as an investor is to be conservative when it comes to my assumptions. So I'm gonna lowball this a significant amount, just so that way we take into account any problems that we may have in the future. Now, obviously, if the oil and gas shortage actually continues, which I've personally foresee that they will continue into the future with the next several, maybe even years, honestly, I honestly think that, well, prices are going to continue to go up, and if prices go up, this will continue to increase this company's profits. So I'm actually going to say for the revenue growth, for the low assumption, would be around like 15%. For the median assumption, let's go to like 18%, and for the highest one, let's go to 21%. Now for the projected share buyback, guys, this is all over the place, right? They've had instances where they increased it, they've had instances where they kept it the same, and they have also bought back. So I do not know, right? I do not know. So for that reason, let's say that for the low assumption that they'll issue shares at around 1%. For the median, let's say that they won't issue shares and keep it at the same at 0. And for the highest one, let's say that they'll buy back shares at 1%. Now with these assumptions, guys, this gives us some target share prices of, now for the low assumption, $5.60, median $6.22, and a high one of $6.89. Adjusting for debt, this comes down by around 30 cents or so to now $5.38, $5.99, and $6.67. Adding a margin of safety of 5 to 15%. This puts me between the ranges of $4.57 to $5.11 for the low assumption. For the median, it is $5.10 to $5.70. And for the highest one, it is at $5.67 to $6.34. Now guys, the current share price is $57.69. So before all of you guys actually jump down my throat in the comments section saying that it will never fall this low, how could it fall down to like $6.99 at the highest? Okay, let's actually get a second opinion, because when numbers in discounted free cash flow doesn't necessarily make any sense. Again, remember, discounted free cash flow works the best for companies that have consistent growing revenue and cash flow, which this company really doesn't, right? So let's actually get a second opinion in the form of book value and tangible book value. Looking at the book value per share, guys, we can see that currently they're at $15.39, meaning that the company should be worth, based off of the assets that they have on their books divided by the current shares outstanding, they should be worth $15.39. And now looking at the tangible book value, which essentially takes out anything that is non-tangible, they should be worth $14.24. So that's actually fairly different than the discounted free cash flow. And I'm half tempted to believe these numbers slightly more than that of discounted free cash flow, just because discounted free cash flow, unfortunately, the fundamentals just aren't there to make a very good an assessment as to what the company should be worth. So for that reason, guys, I'm actually going to trust more these book values per share and tangible book values that the company should be worth at around like the $14 to $15 range. So based off of that, guys, just because I am saying that this should be valued at this point doesn't necessarily mean that you should be buying this company when it actually falls to this point. Guys, every investment is the present value of all future cash flow, and this is not financial advice. So please do not follow what I am doing. Have these calculators for free. I have the discounted free cash flow, the book value calculator, the reevaluation calculator, and a dividend tracking sheet for everybody to have. It is all available for free because my purpose here is to teach everybody a process. And as you guys can clearly see, sometimes the discounted free cash flow doesn't work, right? It happens that way. It's always good to have a second opinion using book value per share and tangible book value per share. Even though these ones don't take into account any assumptions, it's still good for you guys to see exactly what's been going on with the company in the past 5 years when it comes to their book value and tangible book value. So please have these 3 free calculators, a dividend tracking sheet, and even, guys, the weighted grade. You guys may disagree with me when it comes to these grades, so please make your own assessments, make your own grades, and see where you lie at. And all I'm asking for these free things, guys, from my channel, and of course daily content, sometimes you have more than one video a day. All I'm asking for in return, guys, is just like, subscribe, comment. It really does help with the algorithm on YouTube. So far, as if I'm recording this video, we're up to more than 1,100 subscribers. That is absolutely insane, and it just keeps going up and up and up. So thank you all so much for everybody enjoying this kind of content. I really do appreciate it. For everybody who's helping me out in this YouTube journey, it's just absolutely insane. And you guys have given me an opportunity that I have still yet to reap the rewards from. So please, if you guys are enjoying this, I'm not asking for your money. All I'm asking for is just help me grow my channel. Like, subscribe, comment. It really does help. Now let's actually take a look at this dividend, guys, because at $1.55 per share in annual dividends, well, this actually might not be a bad buy, though to be fair, book value is telling me that it is slightly overpriced. Now, if we were to put in 1 month's income, $5,725, this would buy you guys 99.24 shares, and at the annual dividends per share, this will get you $153.84 in annual dividends, quarterly dividends of $38.46, and a monthly dividend of $12.82. So all in all, you know, it could be better, but then again, it's telling me that it is overpriced. So fairly interesting. All in all, when it comes to this company, guys, you know, I get that you told me that the 8% dividend is pretty good. However, as you guys clearly saw, guys, it's just not sustainable on the 5-year average, right? It is very bad, and just their cash flow in general could be a whole lot better. So yeah, on top of that, their fundamentals aren't anything to be amazed about, right? Their profit metrics could be a whole lot better too. Does this company have a lot of prospects in the future? Sure, but right now, their fundamentals just aren't doing it for me. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help her with the algorithm on YouTube. You guys can follow me on my YouTube sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.